All right, welcome to NAAIM Confidential, episode 35. I'm this week's host, Ryan Redfern. Today we have Leigh Eichel from Alpha Vee Solutions. Leigh, thanks for being here.
Thank you.
Leigh is a fairly new member of NAAIM, but he's in this passive active thing. I think is kind of cool. We're going to talk about that, as well as I think it was fundamental momentum is a kind of cool idea he has. So active, but not in the traditional sense. So I really like this spin. Of course, I'm going to start off with the NAAIM Sentiment Index. Let me grab that real quick. NAAIM Exposure Index. I always call it the sentiment. I think that's what we call it internally for the most part. I believe this week we are at 71.9. I think I was around 30. Leigh, do you
90.
You contribute to this, right?
Yeah, yes, I do, and we contribute. We're at 90 right now.
You're at 90. Okay, so and if I recall, you're a little more passive on your reporting, so you're not taking big swings.
No.
So what might be a typical range for your high end and low end of what you would typically report?
We're 0 to 100%, but we try to ignore the noise by quarterly rebalance and reconstitutions.
Okay.
We can do something intra-quarter, but
right.
We try and grip the wheel tight.
Right. No, perfect. Because there are some NAAIM members who are plus 200, minus 200 day by day, which is wild. And then some who have, like you, 0 to 100. Some just report around 50 to 60 every single week and just are very consistent in that range. So I think it's interesting that active management is such a broad idea that there's so many ways to do it. And it's neat to hear from other people who are active. So
absolutely,
thanks for sharing.
Absolutely.
Cool. Stop that. All right. So let's get into you, Leigh. Let's talk about, I think we're going to talk about your investment philosophy, a little bit about your background, and then you also have some cool software that you guys designed. So we'll dive into that and look at some real-time tests. So,
all right. Tell me if you can see my screen and
you can see your screen. Alpha Vee Advisor Solutions. Perfect.
Right.
You are ready to go.
Thanks, Ryan. Thanks to the Heather, Susan, the whole NAAIM group and team. Much appreciate the opportunity. A lot of people don't know about Alpha Vee Solutions, so for your advice, may as well bring up and talk a little bit about us. We started in 2010, and of course, we all have long careers prior. We opened up a U.S. sales. Oh, I should say we're a multinational. So part of the team is in Israel. We opened up a U.S. subsidiary in 2015, an advisory business. There's actually a right and left half to our brain. So one half of our brain is software technology. We have a competitor for your legacy FactSet terminal and Bloomberg terminal. So if you're using those, please throw our hat in the ring. Go get a demo. The other part, though, does investment research, models. We run money and offer research to different groups or help other advisors. Sometimes we co-create, we'll sub-advise, we do all kinds of things. Not going to read it all off, but lots of different experiences. We've launched ETFs with WisdomTree, with American Century Investments. We've worked with hedge funds. We've launched recently some public notes in 2021 that are traded internationally. And lately, a lot of the focus the last few years has been distribution through different platforms. So we got a bunch of platforms that we're on. If anyone listening is on any of the platforms, take a look at the strategies. Feel free to contact Leigh at alphavee.com. We'll cover that a couple of times. So that's about us. So we thought we would talk about. So our view is we coined a concept called fundamental momentum.
Right.
So we're looking at the acceleration and deceleration of fundamentals. We derive that into signals. And those signals are what we use to kind of peer ahead, try and get a little bit of a predictive feeling for where the trends are going in the markets. And I usually use this term, what's over the horizon, right? That's when I get on investor calls or those that have seen me on webinars, et cetera.
Sure.
So we have at least 4 different ways we look at the risks in markets. We'll look at, of course, the overall market and determine our market allocations, and we contribute to the exposure index with that. But we also look at inflation, sector, and selection risks, and that's kind of our DNA. So today, we look at a market allocation where today we're at 90% allocated. And the way we get to that number, right, at because whether you're trading intraday every minute, I mean, there's some decision making with some rationale behind everyone's process, I hope. We look at the overall value of the market, the overall quality of the market. We'll look at 1,200 leading companies in the North American market in this case. And this is how we allocate to our top 5 sectors, SMID, small mid-cap strategy. And looking at that big roll-up and doing a temperature check every 2 weeks, we, at the end of the day, when it's rebalance and reconstitution time, and we do it quarterly, yeah, we have rules to do intraday or intra-quarter changes, but we try and grip the wheel tight and ignore the noise. And the results and the returns speak for themselves.
So what would be a special occasion where you might go outside of your quarterly, your
if we're within the last 10 days of the quarter and the S&P adjusts negatively greater than 5%, I would move the cash, something like that.
Sure.
There's different, what I would call circuit breakers for unusual events. But they have to be very unusual. Now, having said that, in 2020, it happened twice.
Right. Yeah.
This was a great academic exercise. Our specialty is risk management. Terrible for humanity and society. Great for looking at our methodology and risk management, though.
Right.
Is what it is.
Yeah.
So we look at the quality factors, and then we'll look, value factors of the market. Again, rolling up those 1,200 companies. We're doing all the boring work, income statements and balance sheets, and aggregating all this. Sure. And the intersection of those 2 points gets us to a couple of different combinations. In this case, like I said, we're at 90-10. We'll know in another week or two, another week from now, where we're at. Right now, we're seeing a little bit of a decline in quality and value, the way things are trending, and we might move down to 40-60. I don't think we'll move to the right or to the left, probably down on the quality side, if anything. It has to cross over certain thresholds to get us into that 40-60, and it very well could happen. It might happen. Now, the other thing I said, that's the market and the exposure index piece. The other parts that we look at too is, being exposed to the whole market. If the whole market's in decline, doesn't mean there isn't opportunity. We look for what are the 5 sectors most likely to accelerate, which are the other 5 sectors we don't see acceleration in, or likely to decelerate, if you will. And of course, we want to tilt the capital, tilt the recommendations towards what's accelerating. So right now, today, it's cyclical goods and energy and industrials, et cetera, non-cyclicals, utilities. And then, at the beginning of every quarter, we'll equally weight them or normalize them back to the benchmark.
Gotcha.
So that's a little bit about it. The other parts of inflation selection maybe what we can do is, if it's okay, take a look at it interactively.
Let's do that. Love it.
All right, cool. So again, we're looking at now, you can see my screen.
Yep.
Is still the Alpha Vee workstation, which hopefully everyone is signing up for demos as we speak. But the Alpha Vee workstation's got 13 modules, everything from generating all your fact sheets automatically. If you're so troubled to have to do that, we have an automated solution to that. Back testing, optimization, valuation metrics, all kinds of fundamental data all comes in. It's a global tool also, so we can watch individual global equity names. So as I mentioned, in this particular model, maybe we'll just turn off that part, get rid of the noise a little bit.
Okay.
The blue line happens to be our SMID strategy. It's a live strategy, live money. We also have all the historical research. We're looking at the last 3 years. It's all live numbers. And we talked about that 9-cell matrix. We're currently, again, at 90-10. It may move down to the right, to the left, most likely looking ahead the next 90 days. If anything, it'll move down or stay the same. And as the numbers flow in from our sources, and we aggregate it, and it gets reviewed, and the database gets updated with all the live reports, we'll make some type of change and decision. So this particular portfolio, again, we manage about 20 portfolios. This mandate for this portfolio is risk managed, so it's multi-factored, right? There's value, quality, components to it. It's multi-asset. It's not just equities. It's also, we use the for a shock absorber in the portfolio, the other allocation, I should describe the nomenclature. So when you see 90-10, 90% is equities, the other 10% would be treasuries, and that would be IEF, the 7 to 10 year intermediary is what we like to use. Sometimes SHV, but IEF is what we prefer. And
wasn't IEF difficult a couple of years ago when the risk off happened?
Yeah, there are times, I think it's 3 or 4 times where, some of these strategies, and we can talk about when do they not work. They don't work when you have multiple asset classes negatively correlated to the downside. So when you have equities and treasuries falling in the same direction, and it's the down direction, won't work well. It also won't work well is you're looking at buying half the market, right? 5 sectors. Well, what if you botch one of your sector selections? You have a little bias built in by definition. Now, if it's a small sector like telecom, no big deal. If it's a large sector like technology, you're going to underperform. What happens when you have bubbles that build in a sector? Well, it's risk managed. We're trying to avoid those bubbles. But what if it's like a 1.5-year bubble, like we see in tech and the Mag 7?
Right.
Underperformance. We're not going to chase those kinds of bubbles.
Right.
So yes, to answer your question, yep, that it's happened last 20 years, small handful of times. Sure. The other point of this approach, though, with this kind of strategy is we only look at 60-month increments, 5-year increments. You don't use the strategy to jump in and out of. So I could look at any, if I said how to do this 5-year period or the next 3, 4, 5-year period. Right. We're going to see, it's not updating, slow, right? Video, next kind of 5-year period. So you can, if you look at the tree and ignore the forest, you definitely can make a bad decision. And we can pick any one month or quarter where, it didn't light up the way we like. But if we look at the 5, the 3, or the 1-year performance, usually 60 months, you get through an economic regime, we're able to capitalize on value and quality opportunities. And we're not perfect, but we have a pretty good batting average overall. And again, the way it works that I described, you can look at the strategies, how we deployed. Here it was 80-20, went full on equities to right now we're 90-10. We've been 90-10 for a while. Now we're 100%, at a different point.
That makes more sense now. And looking over on the right, you have like the standard deviation. So it looks like anytime, like comparative to a benchmark, you tend to be managing standard deviation versus your benchmark pretty well.
Yes, exactly. And a good point. So that's kind of the yin and the yang. I'm happy to give up some CAGR. Yes, I said it out loud. I'm happy to give up some CAGR, but I want to get some lower standard deviation return for this strategy and this mandate. It's not just a pure growth, high vol kind of thing. This is what I call responsible growth is what we're trying to do and trade off some growth for standard deviation. If I can give alpha and below benchmark standard deviation, our benchmark in this case, because it's SMID, is the Russell 2500. Sure. I feel like we earned our fee and we did a good job for our partners.
Certainly. Yeah. Anytime I've seen a more active manager do well, it's usually because they're managing standard deviation.
Yep.
Very specifically.
It's tricky. It's certainly tricky. But most periods, like I said, if I did that again, most periods you can see sometimes the standard deviation is quite significant. Let me turn off the strategies for a moment. Do 12 to 17 or something, some longer runs, right? I'm looking at that standard deviation again. And then, we underperformed for a bunch, but again, it was risk managed and did well through the pandemic.
But even in these cases, you're not underperforming so drastically that it's like, oh, I should give up on this strategy. Looks like you're right there for the most part.
The key is the forest or the tree. If you're just going to look at that tree, boy, you got to grip the wheel tight. It's hard. It's hard sometimes. It's like everyone knows, it's temperament, right? Just if you believe in that strategy, you hang in there. And hey, there's times when I can probably pick a period, right? We're down, right? We down to all of 2018 and way down. But again, it's that looking. You got to look through it. And some of it's timing, right? Someone that got in 2018 is they're laughing right now and happy as can be if they're hung in there.
Right.
But
right.
if they bailed out, you just got to grip that wheel.
Yeah. But 2018 was tough. It was the way that happened, the way it played out was a difficult market to deal with. It was, even for people being more active. It was interesting.
Crazy Fed, you have crazy American president, trade wars, you had all kinds of nonsense going on.
Absolutely.
And lately too, it's been tough. We didn't have a very good year during the tech bubble, the Mag 7, all money flowing into 7. So you had the Fab 7 and the S&P 493.
Right, exactly.
So that's also tricky for this kind of thing, and tough with some of the sector calls. And we're super optimistic about small caps and SMID. Fully expect the Fed to start becoming more accommodative, lowering interest rates. The small cap and the SMIDs tend to be a little more interest rate sensitive, and I would expect outperformance.
Right. So in this SMID strategy, is it like, what are you investing in? What are you focused in? I think you talked about sectors, but is that individual equities? Are you doing ETFs?
Yeah, no, there's 51 positions. We can open up the portfolio right now.
Thank you.
Sure. So like I said, 51 positions is at the end of the day what we pick, spread across those 5 sectors that I already outlined. Gotcha. And then the extra 1 component is a single ETF, which is IEF right now. And hold on, where is it? There's my 10% position IEF.
There it is.
And my current largest position is LegalZoom.com.
All right.
If I look at the returns, by the way, this quarter, this is how I'm doing. What's performed the best in my portfolio, and our
of financials, cyclical,
some good ones. Of course, got to look at what about the bad ones.
Interesting. Technology being a top one. You've been interesting.
No.
Yeah, there's definitely a rotation going on.
Yep, and that's what's interesting about this approach. Again, it's pretty hard. You got to aggregate a whole lot of data, look at develop them into signals that are reliable and consistent. And so we put about $15 million of our own money building out the tech platform. We also license, like I said, the Alpha Vee workstations available for licensing. Build your own strategies.
Well, do you want to dive into another strategy? This was the SMID. I think you have a few. You said there's 20. Is there any other? We should dive into a couple and just.
Well, sure. If that's okay, happy to. Whoops. Let's get back to one that's gotten very popular. It just got picked up, by the way, on CNBC, I noticed. So if you go onto CNBC.com, click that magnifying glass and type in Alpha Vee, you will see one called Focus Growth. You'll see a few now, actually, that came up. And the Focus Growth has gotten popular, fair amount of AUM. It's kind of an interesting strategy. It's right here. And let's open that one up. So in this case, there's really 2 components to the Focus Growth strategy. One component is 6 names that never change. It's the Fab 6. It's the Fab 6. So everyone says, okay, so who's the missing one? Tesla. We don't, Tesla's too volatile for us. We can't shake our DNA of standard deviation and keeping the vol down. A lot of people love vol, but not everybody. Well, can profit from it, Yahoo. But for a lot of our clients, they're have retail money, trying to dampen the volatility, keep the phone from ringing.
Okay. So this is just a tech basket, basically.
Well, no, it's 6 names plus 14 other names. It's a total basket of 20 names.
Okay.
The other 14 are quantitatively selected. They have to have a $50 billion or more market cap, all have to be US. They can come out of any sectors. It's all growth oriented, little momentum thrown in with the volume quality. Historically done very, very well. Live performance, very, very solid. It's our most volatile strategy. So you can look at that standard deviation. This is not risk managed.
Right.
So it's a full octane and press the gas kind of strategy.
Sure.
You will have scars at times, and that's part of being an equity manager. But if we look through some of the historical performance, right, for longer periods of time, obviously because the Fab 6 is in there, you saw the big run up. But even recently this year, it's doing fine. Last year was out of the park, right? Great
Yeah.
great
And this
performance.
is benchmarking to the S&P 500. Just want to make sure I'm looking at the right
Yes, we have the benchmark of the S&P 500 total return. We could put, we have several hundred benchmarks to
thing.
select
Oh, nice.
from.
Okay.
So if I picked, I don't know, S&P 500 growth, if that's more appropriate, yeah, we could
Be more similar, but
benchmarks.
yeah.
Maybe another way to look at it is just take like the last 3 years and say, just show me how many months did you have active return to the benchmark. So green lines, alpha,
Gotcha.
red lines, no alpha.
Right. Right. Nice. And then do you mind doing the ranking again of the stocks on how they've done
Oh,
over the
sure.
past
Yeah,
few?
yeah.
We did that last time. Might as well do it again.
Sure. Everyone
Don't
wants to
mind.
know. What are you holding?
Now
So
I'm
those,
curious. What's
yep, 20 names. Let's
right?
look at current percentages,
Okay.
right? So you can see the Mag 6
Right.
are equally weighted. That's 60% of the portfolio
Yep.
that we're holding. Now I said Tesla was quantitatively selected. It's
Okay.
they're not in the Mag 6, our Mag 6. They're that one just made it just like right here,
Gotcha.
down here. If we did the returns so far in the quarter, how are we doing?
Tesla, hey?
Got it at a good time.
You
Got
did.
it
You
at a good
did.
time.
Interesting. But most of those big ones are at the top. I think that's fascinating.
Doing fine, but let's look at the other ones, right? Well, doing fine so far. So we're pretty proud of this
Oh yeah. Yeah.
portfolio. But again, remember, you will have scars, as every equity manager does. It is
Right.
a high vol portfolio. As long
Mhm.
as you have that temperament, it's very interesting.
Nice. Nice. And as you said, this one's not really risk managed in the same way. So you're just in for
It's
the
not
ride.
risk managed at all.
Right.
Not risk managed at all. And as I mentioned, if you want to follow it, over time, CNBC and whoops, I can't get to my CNBC screen menu.
I see it. CNBC.
Oh, there it is. Hold on. No, but when I get to the magnifying glass, the Zoom thing comes up.
Gotcha.
Hold on. Let me get to it. Where is my magnifying glass? And there it is. Alpha V Focus Growth. I looked at earlier and jump back. So that's kind of the bookmark. If you do want to follow it over time and
Gotcha.
see how it's doing. Food for thought.
Nice. Yeah. We have a little more time. Do you have a third strategy you want to dive into, or do you have more on your presentation here?
Actually, no, that was the end of my presentation.
Let's
Now
look at
those
the third
are two,
strategy.
I think those are two cool strategies to look at, and a little bit about our philosophy on how we do, boring risk management.
Right. So is there a third you want to look at real quick while we
No,
have
I'll pass on that offer.
Oh,
Thanks.
okay.
I'm just going to keep our cards close to our vest.
No, that's fine. That's fine. We don't have to dive in, but yeah, just kind of sectors.
I mean, we have a bunch of them. Again, you can look them all up on our website. There's a whole bunch, but we manage a all cap, a large cap, a mid cap, a SMID, and a small cap. So we've segmented based on cap, same methodologies, same kind of approach. The all cap's a little bit different because that's just 6 ETFs.
Sure.
But the other ones are all individual names. And just go on alphav.com/strategy. Check them out.
How many of those do you add the risk management to, or is it just the SMID?
All those ones that I just mentioned are risk managed. Then we have a couple more. We have a U.S. enhanced equity that's 100 names, always in treasuries in a big way. The whole intention is single digit standard deviation, low vol, full risk management. Advisors put it into portfolios where you have, you ask them, do you have a client that's afraid of equities? The hands always go up, right? You slide it into that. It'll have better than bond returns, but bond-like standard deviation.
Right. Yeah, bonds are a little bit easier to deal with risk and volatility than
yeah, absolutely.
Generally are. Yeah. Nice.
And then there's always that question, what do you use? In our case, in a high interest rate environment, we'll tend to use TIPS. In this current regime, we're back to IEF. We were in TIPS for quite a while. That's also part of our methodology.
Will much change if the Federal Reserve cuts aggressively next week?
If they cut aggressively, a lot of volatility. A lot of people are going to love that volatility.
Yeah.
But I would expect our small and mid caps. Now's the time to get in the small and SMID portfolios that Alpha V has.
Right. So do
I
you
would,
think, go
I
ahead.
would expect it's just excellent timing in that regard.
Right. And how about any kind of recession fears? Do you think that's a possibility? You think, nah, it's
And
just a thing?
I don't see indicators for any meaningful recession at
Okay.
this point. I looked at, well, just you had a report just come out. What was it, yesterday? Americans are the wealthiest they've ever been.
Mhm.
A lot of that's driven, of course, by homes and
Yeah.
home prices, and then all those transactional sales and gains from homes that have occurred throughout the economy the last 2 years. But still, there's a lot of money sloshing around. But all the indicators from jobs to
Mhm.
GDP, I mean, everything seems to be not what you would expect during a recessionary regime cycle. So managing the slowdown seems to be working quite well. And you
Okay.
got to just be fact-based, data-based,
Yep.
ignore all the emotions, just pure data, and the data seems to be holding up. So it's a pleasure. The macro environment, the
Mhm.
world's on fire, right? So that's always a risk, but it's not showing up in the data.
Yeah, that's true. That's true. The world always feels like it's on fire, but the data is really what makes the difference.
Exactly,
Sure.
exactly. You know,
Well, nice. Well, we're getting close to time, so I'll wrap up with my final questions, which is, what is your favorite investment quote?
my favorite one, which everyone's heard that's seen me speak on webinars, etc., is just a simple reminder. And it's actually my quote. I'm not taking a Yogi Berra one or something like that.
All
But
right.
don't chase performance and don't try and time the market. And I know I'm saying it to the active management crowd, but yeah, that's I'm sticking to it. That's my quote.
Love it. Love it. Well, as we said earlier, or actually before this call, is that the active means so many things. It doesn't necessarily mean market timing and trading. It could be just adjusting or there's so much more to it than that. I think people need to understand that it's not day trading.
Exactly.
Active can mean so many things. Well, within what the framework that you just showed us.
Yeah,
You're, you're active, but not crazy.
and a lot of temperament. Boy, it's hard sometimes to
Yeah.
keep the faith.
Absolutely. Absolutely. All
Emotional
right. Well,
check.
then final question is, how does somebody get a hold of you if they want to say hi, learn about your software?
Give me a call, 617-212-8691. Shoot me an email, Leigh, Leig, at alphavee.com, or go into alphavee.com, and I think there's a contact us button. And
Nice.
just say you want to address me by name, and someone will route that back to me.
Of course. Perfect. And I believe you're not going to be at our NAAIM Outlook conference in October in Dallas, Texas, but we might see you in next spring in Los
Yeah,
Angeles.
next spring, right? I'll be abroad in October, so next spring.
All right. I hope to see you there.
Yeah, likewise. And thanks for the opportunity. I hope it helped all the members.
Absolutely. So it's a good time. Good time. Thanks, Leigh. Good to meet you and good talking to you. And we'll see everybody next time.
Likewise. Thank you.
Thank you.